Welcome to the March episode of Fidelity Soundbites, a straight-to-the-point monthly podcast where some of Australia's leading portfolio managers will share with you what's happening in markets, how they're positioning their portfolios, and the outlook ahead. I'm your host, Andrew Dowling, and James Abela joins us once again as we look back on March and discuss some of the key signals in markets right now.
Hello, Andrew.
Hey, James, how are you? Welcome again.
Thank you.
So, let's face it, a somewhat tumultuous month for US and European financials. What does it mean for us here in Australia?
There's a lot going on in March. There's M&A, there's obviously the blow-ups of the US financial system, and then Europe got involved as well. So SVB, Credit Suisse, all of this was very damning for confidence for the whole world. The financial system, people were worrying about taking our minds back to the GFC. I guess for Australian, it's very important to realise that our financial system is very, very strong. So the US financial system is a very different two-tier system. Regionals now in a very difficult position. Europe also very difficult positions right across the board with the weaker ones. But Australia is very strong, very well capitalised. We don't have many exotic activities taking place in the Australian financial system. So it's just good to know that at least our Australian system is going quite well. And I think we're in a good spot, so we don't have as a lot to worry about as they do offshore.
Right. And so we have big banks and, well, not so big banks or smaller banks. That doesn't make any difference in terms of...
Well, there's the big five, obviously, big four banks plus Macquarie, and then you've really got the two regionals, which is in my world. And the two regionals will be affected by funding, but obviously held them for a long time as a subscale and things like that. But just not a lot of impact, I guess, for our system because we don't source capital offshore in a way that, will be affected by this big liquidity crunch. And that's really, I guess, where the comfort comes from. So
good to hear. And certainly another interesting month after too many interesting months with rate rises. A pause this month, what does that mean for your world, sort of Australian mids and smalls?
Yeah, it's big. 10 months we've had rate rises upwards and now we're finally having a pause. And people have been calling for the pause for quite a while. And now it's finally come, thank goodness, because people are being affected by cost of living increases anyway without rates going up as well. What does it mean in terms of stocks? That really people are pausing and having a think now that, rates are going to be at this high level and kind of hold there for a while, but they're not going to keep going up. So the panic, I think, is now starting to subside, but the reality of earnings needing to be there is what's happening. So as that rate rise has started to lift, the value style really worked. And the momentum obviously was the opposite. It didn't work at all because the cost of capital was rising. Now you're getting really quality working. So quality names are really working. Companies that have earnings, companies that have growth, companies that have duration is what's really happening now. So with rate rises being continuous, people's duration had actually went very short because they got very worried about the future. And they started to really discount anything that was very long dated. And now it's kind of becoming a bit more balanced because the markets are moving their duration out and happy to think that they kind of can see what's happening over the next few years. And that's why quality, I think, is now starting to work well. But also transition names, which I call turnaround names or self-help names, are also going quite well. And that sort of, momentum and value styles are not working as well because the market's not in fear or greed mode. It's in kind of reality mode. And that's where the signal really sits. It's more real earnings, real cash flows. And that's where you need to really go towards now. And that's, I think, what has worked during results, but is certainly during March as well.
And just on that front, obviously companies that have a positive outlook. Some of them have certainly hung on to those share price gains that on the back of reporting season. Can you talk us through just a few of those companies, the ones that stand out as?
Yeah, I think the ones that have continued to do well are ones that there are earnings growth. So really much insurance, technology, some healthcare names, they've done quite well, and also resources. So gold has done quite well because it's become a bit more of an anti-market kind of theme. Didn't really work during COVID, but has worked. But it really is earnings. And it really is, in those areas where there is earnings growth, that's really where it's being rewarded and continues to be rewarded.
And is that getting harder to find? It
is getting harder to find. That's the thing. Those quality names have already run up quite hard. So a lot of those healthcare and tech names have run quite hard. So the bifurcation in high quality, high growth, and then your lower quality, lower growth names, that spread became very short, say 6 months ago. And now it's sort of started to move out. You got companies like WiseTech on 60, 70 times, Altium's on 30, 40 times. And I think that's the concern now. It's starting to get harder to find opportunities. And that's where you talk to traders and trade volumes are down and they're a lot lower than what they used to be, say, 6 months ago.
Increasingly so. And One area that did pick up also for the quarter was M&A activity, something that's been
it was
somewhat
huge.
scarce in recent times.
Yeah.
Can you talk us through some of the drivers behind that? What's that signaling to you? And also, what are the risks and opportunities that come from M&A
Certainly,
waves?
no, it was definitely huge. I mean, Liontown got bid for, United Malt also, and also Helios. So those three are quite different, one in healthcare, one in malt, which is beer related, and then Liontown, which is resources. So M&A is coming up because growth is getting very scarce. It's getting harder to find growth. So I think utilising balance sheets, which have been in a good position during COVID. Also, it's a low growth road, so you're kind of buying growth as well. And the other thing is also going down the value chain to secure supply or going up the value chain to either get leverage or lock in consumers. And that sort of movement up and down the value chain has also been an important thing. And then the last one is really just leveraging and costs, so getting bigger scale. It's when you've got this environment of high inflation, tight supply, nervous customers, and increasing cost bases, scale becomes much more important. So I think companies are also going for scale. So a lot of those M&A trends, they will continue during 2023. All those drivers underneath them and the signal that it tells you, that is going to be there for the whole of this year. And it's in a whole different range of areas, resources, materials, healthcare, technology. And you're seeing it not just domestically, but globally. So I think those trends is a signal of lower growth. And so I do think that'll be there through the year.
Right. And when you talk about, just on that point about gold, record prices.
Yeah, gold's near record prices. It had huge performance during March, just massive. So some stocks were up 50, 60%. The average is sort of around 20 to 25%. Evolution, which we had a good run, was up. So, I think gold is now being seen as a safe haven that it traditionally was over the decades, but during COVID it wasn't seen as, because money was very cheap. But now you've actually got financial system fears of the system, and that's why people are going towards low beta stocks and also gold. And gold has now become the safe haven, which its core, I guess, is when you have fears about the financial system, which is where it's going well now, especially during the month of March. People say we may be getting towards the end of that rally, but gold has been a massive theme during the month of March, it makes a lot of sense now. And it's surprising that it hasn't. I have clients asking me through the whole of the COVID crisis, why hasn't gold gone up? Why hasn't gold worked? Why aren't the stocks going up? And then you had that for 3 years. And then the last 3 or 4 months, it was, they've all had cost blowouts. They've all got CapEx upgrades, so they're not working. But then in the month of March, all of that was pretty much changed, and it became, one of the one of the strongest sectors right across the mid-cap space.
Right, and materials, nearly 30% of the index?
Yes.
We're living in a material world? Are we likely to continue living in a material world to that degree?
It really is a material world. I mean, materials as a percentage of my universe has only been at 30% in 2008, 2011, and just only towards the end of last year, 30% of the index. That's just huge. It normally is between 10 and 20% over history, or 15 to 20% really over history. And you've got so many factors happening. You've got lithium being a huge theme in Australia. We are a big producer of lithium and have a huge number of lithium stocks. We also have rare earth stocks and other related transition metals. And also gold is still a pretty big part of the index in mid caps and small caps. And then also all the copper and nickel and lithium names from transition. And there's also M&A. So there's a lot going on in resources. We've actually got a special bonus episode, including the analyst here, Sam, will be getting involved and giving you an update on Australian resources, because there's a lot of exciting things happening. We've got a lot to offer the world. We export a lot of resources, and it's a big part of our market. And I do think that it is, definitely this month especially, it's been a material world, but the whole year of last year became very much dominated by resources and materials.
And James, speaking of signals, there continues to be a major mismatch in consumer sentiment data, sort of back to GFC levels, and actual consumer behaviour. What's your take on this?
Yeah, I find it quite phenomenal. I mean, if you look at the Reserve Bank chart back they put out every month, it's back down to 70, which is back to GFC levels. It's very, very low. But if you look on the streets with your eyes where you can actually see, you look at roads, schools, airports, cafes, hotels, shopping centres, holiday destinations, rental accommodation, inspection, business trips, or preparing for a family gathering, everything is busy. Everyone is busy. And so it's really a big mismatch. All you can see, and retail sales are still very strong. The analyst here is saying that the discounting is broadening and deepening in terms of retail. But there is a big mismatch. And you don't know if people are just shifting their spending from buying things to buying moments and buying experiences. That's what it feels like. And when you look at the sort of where the wallet is going, that seems to be what is happening. And the signal is definitely people are shifting towards moments and memories and moving away from things and household goods. So I think that's something you need to keep in mind when you're investing in certain stocks. But I do think it's quite a big mismatch between what the data is telling you and what you can see with your eyes out there in the streets.
Well, we'll continue to see how that plays out. Well, on that note, thank you, James. Very much appreciate you joining us again today.
Thanks, Andrew.
And if you've enjoyed this episode, please share it with a friend and subscribe to the podcast via your favourite streaming platform. And we look forward to having you join us next month.
Thanks a lot. Thank you, everyone.
Thank you.
Some important information on today's podcast. This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.